Hello everyone, welcome back into the channel. Uh, Please make sure that you are subscribed and you're liking the videos that we're posting, and then also just sharing with the rest of your mates so that you can be able to support the channel as well. So I'm reading like the comments from one of the other videos that are already here for accounting. So there's one person that made a comment about the fact that they couldn't see what I was writing. So I've basically linked that. I've basically made sure that I now link all the spreadsheets that I'm writing the answers on so that you can also be able to check directly from the spreadsheet. This is maybe just watching on the video and it's not zooming well, but I think now it's going to zoom well anyways, but just for maybe if your eyes aren't that great. And then the rent calculation being tricky. Yes, it does get tricky sometimes, but just try and rewatch the video and see if you can try and replicate that same process. In many other videos that we're going to be doing in the future, we're going to be doing that calculation again because in accounting, a lot of the things that typically get asked, it's basically things that are very repetitive. So if we practice enough past papers, then we should be able to be good. And then one more thing is someone asked if I have June 2024. And so for this lesson, I then decided that I'm going to be taking the June 2024 paper one. So I'll be covering paper ones for now, but I will at a later stage and at some point start covering the paper twos. But yeah, so in this session, we're going to be looking at the June 2024 paper. And in that June 2024 paper, you can see that we got our answer sheet this side, and then we got our spreadsheet. Spreadsheet is not yet numbered, but don't worry too much about that. And then we got our question paper right here. So if you want us to basically cover anything, just make sure that you leave it in the comments. We do read them and we take them into account in the videos that follow after that. So without wasting any more time, let's jump straight into this question. So as normal, the first question focuses on company financial statements. The first piece of information says that we need to refer to information A. It says the bookkeeper has recorded all the entries regarding fixed assets in the books. Then it says complete the amounts denoted by number 1 to 3 on the fixed asset note. So essentially, we're looking for the cost of buildings at the beginning of the year. We're looking for the depreciation on the vehicles, and we're looking for the disposals at carrying value for equipment. All right, cool. So let's start with number one. Now, with number one, if you just look at the information that is given here. So pretty much all the information that you got on buildings is pretty much this. If you read the other information, you'll see that there's no mention of the buildings. So we can basically use this information. Now, what do we know about buildings or land and buildings is that we don't depreciate them. And so their carrying value is always equal to their cost. And so if it is disposed at carrying value, it means that its carrying value was the cost minus accumulated depreciation. And the accumulated depreciation was zero, so that makes it equal to the cost. So to find the first answer there, so let's try and answer number one. So this is 1.1, I think. So you're going to take I, so you're going to say I, and I is basically going to be equal to, so we're going to take this balance at the end. So this carrying amount at the end, right? And then we're going to subtract the 420,000, and then it's going to give us what we need for the additions. So, and by the way, I said you subtract, but no, you don't subtract, you actually add, because remember that you take the balance at the beginning of the year, and then from the balance at the beginning of the year, you would subtract your disposals to get to the carrying amount at the end of the year. But since in this case, we are basically starting now from the bottom, so we're starting from the carrying value at the end, and we're trying to get back to the beginning. So to get back to the beginning, we just basically need to add back that 40,000. Sorry, not 420, not 40,000, but 420,000. So that would be our calculation there. and then this would be our answer over here. So that would be 9,400 and 9,841,300. I'm just going to make these numbers financial so that it's easier to read. All right, so that's number one. So number two, what do we need to work out? Well, number two, we need to basically work out the depreciation on vehicles. Now, remember that whenever you're working out depreciation, you basically have three classes that you work with. So the three classes that we always work with is that we calculate depreciation on new vehicles, depreciation on disposed vehicles, and then lastly, we calculate depreciation on our old vehicles. By new vehicles, we mean the vehicles that we purchased during the current financial year. Disposed vehicles, we're talking about calculating depreciation on vehicles that were disposed in the current year. And then by old vehicles, we're basically referring to vehicles that were there from the beginning of the financial year to the end of the financial year. So if we have these three classes and add them all together, we'll basically get our depreciation amount. Now let's look at the note again. So as you can see here, the disposals at carrying value is pretty much zero. So as it is zero, it means that we didn't dispose any vehicles. And so as a result of that, we won't have one class, so we just have to focus on two classes. One class being the vehicles that were added during the year, and then also the vehicles that were there from the beginning to the end. So now let's look firstly at the new vehicles that were purchased in the current year. So we purchased 260,000 worth of vehicles. That would be the cost of the vehicles. And then the depreciation method that has been used is the cost method or the straight line method, and the depreciation rate is 15%. So that makes things fairly simple. So we're pretty much then going to take the 260,000 multiplied by the 15%, and then we apportion by the period. So if you look at the apportionment that we need to do is 1 October 2023, and then remember that our financial year ends on the 29th of February 2024. And so what you'd need to do is you take the 260,000 multiplied by the 15% and then multiply it by the months. So how many months are we talking about here? We're talking about October, November, December, January, February. So that's total of 6 months. So let me just do it again: October, November, December, January, February. So I'm actually wrong. It's 5 months. All right. So then, since we got 5 months that we need to basically work out the depreciation for, let's then go and apply that. So we're going to go here. We're going to do our calculation that we have 260,000, and we're going to multiply by 15%, and then you're going to multiply by 5 over 12. All right. And so we got depreciation on one class of vehicles of 16,250. And then lastly, we have the other class of vehicles, which is the old vehicles. Remember that we have no disposed vehicles in the current year, so that's cool. But then the old vehicles, we have a carrying value. So we have a carrying value for the old vehicles, but we don't have the cost, but we need the cost to calculate. Well, the way in which we would work out the cost is pretty, well, I don't want to say easy, but it is easy maybe for me. Okay. So the way in which we would do this, well, we have the cost at the end, right? And then we know that the cost at the end includes the vehicles that we bought during the current year. And so in order to get the cost then at the beginning, because remember that we have no disposal in this case, so the only thing that happened to the balance at the beginning would have been to add the additions to then get the cost at the end. So then you can use that same logic then, that you can take the cost at the end, you then subtract the additions you did so that you can get the cost at the beginning. So that's what you're going to do then. So we're going to say, well, 786,000, which is basically all the vehicles that the business has. And then we're going to subtract the vehicles that we purchased during the year, which is 260,000. Now that will give you the cost of the old vehicles. And then once you have that cost of the old vehicles, you then will multiply by 15%, And in this case, we don't even need to apportion because basically 12 over 12, which is 1, and then that will give us 78,900. And then what we do then with that information is that we would add both of these to then get our number 2. So our depreciation on vehicles is basically 95,150. All right. So that is it. Pretty straightforward. Hope everyone understands. Let's move on then to calculate the third thing that is on this list, and that is the disposals at carrying value for equipment. So that means that then we basically need to calculate the carrying value of the equipment item that was disposed. So let's look at the information then about this equipment that was sold. So what does the information say? So the information here says that an extract from the fixed asset register in respect of equipment sold. So it says that the cost price of this equipment was 80,000. It was purchased on 1 September 2021, sold on 31 May 2023, sold for 53,000. And then we can see that the carrying value of this equipment you know, has updated a bit because obviously we had a carrying value at the end of 2022, carrying value at the end of 2023, and then now it is sold on 31 May 2023. So that basically just means then that we basically need to calculate the depreciation, in the current year relating to this specific piece of equipment that was sold. So then, and then the method that we use to calculate depreciation for equipment is the diminishing balance method, which basically takes the carrying value, you multiply by the rate, and then you multiply by the apportionment of the months that the item was in the business in the current year. So then in this case, we got the carrying value, right? Because the carrying value at the end of 2023 would have been the carrying value at the beginning of the current year, right? So 57,600. Then we're going to take that 57,600 to multiply by 20%. And then once we multiply by 20%, we then would multiply by the number of months it was in the business in the current year. So that would be March, April, and May. So that's basically 3 months. And so then we would basically say, well, let's do that. So let's work out current year depreciation on this equipment. So the current year depreciation, which is, by the way, not what we are looking for, but it will assist us in finding what we're looking for, because ultimately we will take that current year depreciation and subtract it against the carrying amount that was existing. So then we're going to have what's the carrying amount? 57,600. So you're going to say 57,600 multiplied by 20%, and then you're going to multiply by 3 months, and those 3 months are March, April, and May. So 3 months of 12, and then that's going to give us a depreciation of 2,880. And then after that, what we then do is that we want to find the carrying value on the 31st of May 2023, right? So the carrying value on that date will then be the carrying value at the beginning of the current period minus the depreciation in the current year, and that would be 2,880. And then we will get our answer there to be 54,720. All right, cool. So I hope that makes sense for everyone. And from now, then we're going to then move into the next question, which is 1.2. All right, so next question, just want to show here that we basically working out the correct net profit. And this is basically the structure then. So what I'll do is that I will just take this and put it here, so that I don't have to refer back to the answer sheet as much, and I can just basically take this information as is. So basically, what are we given here? We're given the incorrect net profit before tax, So what is that incorrect net profit before tax? It is 1,150,000. So then now in that amount that we've been given, we then would need to figure out basically what are some of the things that were not taken into account when that net profit before tax was calculated. So let's go then and find the relevant information for this. And also it says that, refer to information C and D, so you kind of have a direction. So B is basically just, the list of balances may be relevant for this, but mainly we want to basically be looking at C and D. So C, it says the bookkeeper calculated the net profit to be 1,150,000. The pre-adjustment balances to be adjusted are the following. So we got the audit fees for 144,000, and I want to see something. So we have the balances here. So okay, we don't have audit fees. Okay, that's cool. Trading stock, directors' fees, rent income, all of that. So let's look at the information. What does the information say? Remember, we're looking at C and D. So it says only the adjustments listed below must still be taken into account. It says audit fees of 445,600 we're still owing on 29th February 2024. If you remember, our matching principle when it comes to GAAP principles is that we need to ensure that we match expenses with the year in which they belong in. So if we owe 45,600 on 29th February 2024. That must be relating to the work done in the 2024 financial year. And so as a result of that, we would then take into account that 45,600 in our calculation. So then we're going to say, firstly, audit fees. Now, audit fees is an expense, so it would decrease this profits because it hasn't yet been taken into account. Okay, let's look at the next piece of information that's going to be relevant. It says a donation of 100 blankets was made to a children's hospital, but the donation has not been recorded. The business uses the weighted average method for valuing blankets. The stock records for blankets reflect the following. Okay, there we got our blankets. We purchased some during the year, and then we got the sales, and then we did the donation. Now, this needs your knowledge of inventory. So that's why then in accounting, you need to basically be able to understand different topics at once, because this mainly is a topic that relates to inventory paper too, but it's coming up now and we need to be able to handle it. So we made a donation of 100 blankets. Now, what was the cost of those blankets would be the question. And then the other thing that we want to make sure that we remember is the fact that when we are using the weighted average method, which is mentioned there, is that to calculate the cost under weighted average method, we basically take the number of units, which is 100 for the donations, and then we multiply by the weighted average cost. And then how do we work out the weighted average cost? Well, weighted average cost is calculated by taking the total value of goods available for sale, right? And so in this case, what is available for sale? Well, 603,000, because we purchased 603,000 worth of vehicles at the start of the year, right? Sorry, not at the start of the year, but we basically have 603,000, which is basically 603,000, which is the total purchases for the year. So that would be the blankets available for sale. And then after that, we'll divide by the units available for sale, and then that will give us our weighted average cost. So our weighted average cost, let's work out the calculation. So we're going to say weighted average cost. I'm just going to say WAC. It's basically going to be 603,000 divided by 1,500 blankets. And so that means then that our weighted average cost is going to be 402. And so to calculate donations, and remember that donations is an expense, and so it would further decrease our profits. So, and it will be calculated like this: 100 units multiplied by 402 Rand per unit in terms of the cost. And so that will give us our That will give us the total for donations. All right, cool. Now let's move on to the next thing now in this information, because remember these donations we had to be taken into account. It says rent was increased by 1,300 on 1 January 2024. Only the rent for the period 1 March 2023 to 31 January 2024 was received and recorded. Okay, so you can see here that then if you look at 1 March 2023, which is the beginning of the financial year, to 31 January 2024, that basically means that we received the rent only for 11 months in the current year. All right. And then it says that the rent was increased by 1,300 on 1 January 2024. So basically it means that 10 months of this rent were received at a rate that is 1,300 less than what was received for January 2024. And so we then need to figure out, well, what is the rent for February 2024? Because we basically want to add then that to our incomes, because even though it hasn't been received, the rent for February, it still needs to be accounted for because of the matching principle, which is we need to match our incomes and expenses to the year they belong in. So that February rent belongs into the current year, and we just need to work out how much it is. So how do we work out how much it is? Well, we know that we received 287,300. So I'm going to write it here that we received 287,300, and this was basically for what? This was for 11 months, right? So this was for 11 months, right? But then we need to remember that 10 of the 11 months obviously include rent at the rate before there was an increase of 1,300. So then in this case, if you want to basically work out firstly the rate without any influence of increases. And so we need to take out the effect of an increase. So to take out the effect of an increase, we'd have to take out the increase, which is 1,300, and that increase in this case has only been valid for a month in these 11 months. So then we would just need to do 1,300. Now, if the rent, for example, had increased 2 months ago, then in that case, it would have been 1,300 times 2 that we need to basically subtract from that 287,300, but it's only 1 month in this case. And so that means then that had there been no increase, if there was no increase in the rental, we would have received 286,000 for 11 months. So then what is the monthly rent before increase? So the monthly rent before the increase would have then been the 286,000 divided by 11 months, because we only received the rent for 11 months. So that's 26,000. But then the rent receivable, because remember that this rent is still receivable for for February 2024. That rent receivable for February 2024 includes the interest now, so it's basically going to be 26,000, which is the rent that we're paying before there was an increase, plus that increase of 1,300. And so then our rent receivable is basically going to be 27,300. And the entries that we basically do for that is that we debit our accrued income, which is an asset account in the balance sheet, and then we would credit rental income. So in this case, we have more rent income, and rent income is an income, and it has a positive impact on our profit. So then we would go like this: 27,300, and it would be positive. And then let's look for more information. Maybe it says here that the company had one director, Jenny. At the beginning of the financial year, Jenny had been paid in advance for 2 months. A second director Frank was appointed on 1 December 2023. His monthly fee is low is 20% lower than that of Jenny. Frank received the fees due to him. Okay, so this is interesting, and it requires quite a bit in terms of the calculations that we need to be able to do. And it's going to be one of those complicated calculations, but hopefully you do understand once I've done this calculation. All right, cool. So let's look at these directors, right? Let's look at these directors and see how we can basically work this out. Okay, so the first director, you can see that they basically received 2 months in advance. So if you receive 2 months in advance, well, you're not supposed to include that in the income statement. So we'd need to reverse the effect of that particular director. So the normal effect of director's fees is that it decreases profits. But in this case, because we basically have this director that we paid 2 months in advance, meaning that we paid for 2 months that are outside the financial year. So if we work out that, that basically then would mean that we have what do we have? We basically have a situation where we need to basically then reduce our directors' fees, and reducing directors' fees has a positive impact on net profit. So whatever amount we get here is basically an amount that we're going to be adding into these profits. Okay, cool. So then what we need to understand, what we need to basically find out then is, well, how much was the director, the first director specifically, because this is basically the transaction here, how much was the director getting per month? Or how much did this director receive in advance? And that is the amount we basically need to basically then add back into our profits. So the way I like to do this is basically using the percentages. And so we're going to look at what each director earns in percentage terms, because once they tell you that one director earns 80% less, then you can basically work with that, because it gives you enough clue to be able to work with. And no, it doesn't seem like a lot. It's kind of a complicated calculation, but it's very, very doable. So what you're going to do is going to look at director one and director two. And even though these calculations can be long, but we need to keep perspective of why we're doing these calculations. So we're doing this calculation essentially because we basically want to work out how much was paid in advance to the other director. Basically, we're working out our prepaid expense towards the director, right? So how do we do this? So, well, the first director that was there will say that they earn a salary of 100%. So, and let me just write it in percentage terms actually. So I'm going to say 100%, and they receive this salary for 14 months, because that 800 that is director's fees is basically 14 months for one director, because they received a salary for 2 months in advance. And so that would mean then that over the period of 14 months, they would have earned a salary equivalent to 1,400%. The second director that was hired during the year on 1 December 2023 received 20% less than director one. So, in other words, then 20% less than 100% is 80%. And for them, they were only in the business for 3 months, and they only received their due salary. So they had no prepayment that was there. Let's make sure we look at that information. We can see that his monthly is 20% lower than that. Says he received what was due to him. So what was due to him is December, January, and February. So in other words, then they would have received for 3 months. And so 80 multiplied by 3, that's going to give you 240. So that means then that they received 240%. In other words, we paid our directors a combined total. We paid them a combined total of 1,640%. Let's just add the percent there. That's how much we paid our directors. And then to basically work out, now remember that this 1,400% is an equivalent it's an equivalent of the total, which is the rand value, 852,800, right? So if it is an equivalent of 852,800, we can then be able to calculate the equivalent of the 2 months that were received that lie outside the current financial year. So how do we work out those? Well, we're going to say the advance payment, then we're going to take our 852,800, and then we're going to multiply by what we're looking for. So what we're looking for is 200%, and then we're going to divide by what we have, and what we have is the 1,640%. And so when we do that calculation, it will give us 104,000, as you can see. Then the next thing that we need to then do is to then come here and then do our director's fees. So our director's fees work out to 104,000. Now that we got our director's fees, I think that's all the information that we got there. The next information is on tax. So the tax has its own part in this statement, as you can see. So we got our director's fees, and then the next thing then is to calculate the correct net profit before tax. So the correct net profit before tax is basically just the total of those. So we're basically going to take 1,150,000, subtract 45,600, subtract 40,200, add 27,300, and also add 104,000. Okay, so that works out to 1,195,500, and then we have income tax. So our income tax expense for the current year was given in D, and it was given as 351,000. So then we're going to come here and subtract it, 351,000, and then we'll get our net profit after tax. So our net profit after tax is then going to be equal to 844,500, and that's basically then the end of question 1.2. I know that last calculation for director's fees was a bit complicated, but I hope that you got something from it, and you can come and check this particular spreadsheet to verify these calculations, as I will make sure to link it in the video description below. So yeah, that is it, and let's see what's the next question. The next question here is completing the statement of financial position. That's 30 marks, so I will not do it in this video, but I will do it in the next video. So cheers for now. Please make sure that you like, comment, and subscribe, and also make sure that you share with your friends. Until the next video, cheers.